Ever wondered what happens when those multinational corporations, the MNEs, when they face a shift in the tax code?
Yeah, do their investment dollars just sort of dry up?
Right. Or do they find, like, sneakier ways to, I don't know, maybe hold on to their profits a little tighter?
It's a question a lot of people are asking.
For sure. And it's the question we're diving into today, actually.
We're talking corporate taxes, M&E investment, the whole shebang.
All thanks to this super interesting OECD working paper we dug up.
It's got some pretty interesting real-world data in it.
Oh, yeah. We're talking firm-level insights, not just some theoretical mumbo-jumbo
These
or
17 countries, mostly in Europe.
a whole decade's worth of data.
It really makes you rethink some of those assumptions we tend to have about, well, about how companies react to these sorts of things.
Assumptions. Like, totally busted.
It,
So to set the stage, we're in this whole moment, right? This pivotal
with
moment.
international tax reform, for sure, especially in our digital age.
You're telling me, the OECD is practically drowning in proposals, right?
Trying to make corporate taxes fairer, level the playing field.
Exactly. And it seems like those effective tax rates, they're probably going up, particularly for those MNEs used to those low tax havens.
Oh, absolutely. The writing's on the wall. And that's why this deep dive is so well timed,
Totally.
because we're going to explore how these potential tax hikes might actually change where and how much these MNEs choose to invest.
Okay, so before we go any further, let's do a quick knowledge check for our listeners, just to make sure we're all on the same page.
I like it. Quiz time.
Imagine you're an M&E executive, right? Big office, corner view, the whole bit.
Living the dream.
Exactly. And you're looking to invest, make that money work for you. You've got two countries on your radar. One's got a 15% tax rate, the other 25%.
Okay, I'm following.
Where are you more likely to invest?
On the surface, it seems like a no-brainer, right?
Right?
Lower taxes, higher after-tax returns, basic economics. But, as with most things in economics, it's rarely that simple.
There's always a catch. And I have a feeling this OECD paper, it peels back a few layers, am I right?
Absolutely. They don't just look at those basic tax rates, they use a much more nuanced measure. They look at what's called the effective marginal tax rate.
Ooh, the EMTR.
Exactly.
I love a good acronym. So what's so special about this EMTR?
Well, think of it like a tax forecast for your next big investment. It goes beyond just those basic tax rates you see in the headlines and really helps us understand if a country's tax system encourages companies to invest more or, maybe encourages them to hold back a bit.
So it's less about what a company paid last year and more about how taxes might influence their next move. Is that what you're saying?
Exactly. It's about those future investments, those expansion plans, and that's what the MNTR captures so well.
Got it. Makes sense. Now, here's where things get really interesting, at least for me. The paper, it doesn't just look at EMTR in isolation. It digs into how a company's profitability affects how sensitive they are to those EMTR changes.
And that's where things get really fascinating.
Because what they found is pretty cool. They actually found this U-shaped curve.
Completely flips the script on how we typically think about this.
So for our listeners, break it down. What does this U-shaped relationship tell us? Like, who's feeling the heat the most from these potential EMTR shifts?
Well, those companies in the middle, those with, say, profit margins between 0 and 10%, they seem to be the most reactive to those EMTR changes.
The ones who are, like, not rolling in dough, but also not exactly struggling.
Precisely. They're walking a bit of a tightrope.
It makes sense, though. Any little change in their tax burden, and it could really impact their bottom line.
Exactly. But here's the twist.
It may.
Those companies at the extremes, the super profitable ones and those barely breaking even, they seem less fazed by these potential EMTR increases.
Now, that is interesting. Why wouldn't those struggling companies be, freaking out a bit more? It's like, shouldn't they be hitting the panic button or something at the first mention of a tax hike?
You'd think, right? But the paper actually suggests a couple of possibilities, and they're pretty interesting.
Okay, I'm intrigued.
So, first off, those companies that are struggling to turn a profit, they might already be kind of shielded from corporate taxes in the first place.
Shielded. How so?
Well, think about things like loss carry forward provisions, right?
Right, right.
They're not really paying much, if any, corporate tax currently. So these EMTR changes, they don't really move the needle for them in the short term.
So it's like they're in a bit of a tax-safe zone, at least for now.
Exactly. Now, for those high rollers, the ones raking in the profits, it's a bit of a different story.
Yeah, you'd think a tax hike would at least make them think twice before, investing even more.
You'd expect a little hesitation, right?
For sure.
But there are a few theories about why they might be less bothered by these potential EMTR changes compared to those middle-of-the-road companies.
Okay, lay those theories on me.
All right, so one argument is that these super profitable companies, they just have more financial wiggle room.
More cash on hand.
Exactly. Cash reserves, easy access to credit, maybe even a stock market that loves them. They're not as reliant on borrowed money, so they're just better positioned to weather a tax storm.
It's like having that comfy financial cushion. A little bump in taxes here or there isn't going to derail their grand plans.
Exactly. Plus, some experts argue that these market dominators, they've already made those big strategic investments. They've kind of staked their claim.
They're already at the top of the food chain.
Precisely. So they might be hesitant to pull back on investments, even with slightly higher taxes, just to maintain that dominance.
It's less about making the initial leap and more about staying ahead of the pack.
Exactly. But there's another piece to this puzzle, something else that might explain why those high-profit companies are so unfazed.
Okay, there's more. I'm listening.
Remember how we talked about EMTR reflecting those tax incentives for future investments?
Right, like a sneak peek into the tax implications down the road.
Well, it turns out some of those incentives might be less about encouraging new investment and more about minimizing their current tax bill.
Ah, you're talking about those tax planning strategies.
Exactly. We couldn't have this conversation without mentioning those.
Of course not. It's like the elephant in the room, or maybe the tax lawyer in the boardroom.
That's a good one. But in all seriousness, the study does hint that those ultra-profitable MNEs, they might just be really, really good at optimizing their tax strategies.
So they're playing 4D chess with the tax code while everyone else is stuck on checkers.
Something like that. And that expertise, that savvy maneuvering, it could be another reason why they're not as bothered by those potential domestic tax increases.
Okay, so let me make sure I'm following. It's the companies in the middle, the ones without those huge cash reserves or those fancy tax strategies. They're the ones really feeling the heat from these EMPR changes.
That's the gist of it, yeah. And this is actually super important when we think about those potential international tax reforms that are being floated.
Because if the most profitable companies, the ones most likely to be affected by those reforms, if they're not that sensitive to these tax changes, then maybe the overall impact on investment, maybe it won't be as dramatic as some people are saying.
It's not that the reforms won't have any impact, but the relationship between corporate taxes and investment, it's just way more complex than it seems on the surface.
It's not as simple as raise taxes, investment goes down. There's a whole lot more going on under the hood.
Exactly.
It's tempting to think, those big MNEs, they'll just slam on the brakes the second they see a tax hike coming.
Right, like a knee-jerk reaction.
Exactly. But maybe, just maybe, they're playing a longer game here, one where a small tax increase here or there, it's not going to throw them completely off course.
I think that's a really important point. This OECD paper, it really highlights just how complex these decisions really are. It's not as simple as taxes go up, investment goes down.
Right, it's so much more nuanced than that.
Exactly. We're talking about profitability, access to capital, their overall tax strategy. There are so many factors at play.
It's a whole web of interconnected things, and it really makes you realize that corporate finance, it's rarely black and white. Trying to predict how these global companies are going to react to something like international tax reform, it must feel like, I don't know, like trying to predict the weather sometimes.
Oh, absolutely. And just like with the weather, we can use all the data and all the analysis in the world to try to make informed predictions, but there are always going to be those unforeseen circumstances.
Those wild cards that throw everything up in the air. So we've covered a lot of ground in this deep dive, from EMTRs and that fascinating U-shaped relationship we talked about, between profitability and tax sensitivity, all the way to the potential impact of these international tax reforms that are on the table. But for our listeners who are still with us, eager to learn more, what would you say is the biggest takeaway from all of this? If they could only remember one thing, what would it be?
I think the biggest takeaway here is that corporate taxes, they're just one piece of a much larger puzzle, at least when it comes to how MNEs make investment decisions.
Right, it's not the whole story.
Exactly. While higher taxes, they can definitely play a role, it's not a simple cause and effect relationship.
It's not as straightforward as some people might think.
Right. There's always more to it than meets the eye. And that's what we love about these deep dives.
Absolutely. It's about going beyond the headlines, digging into the details, and finding those surprising nuances.
Couldn't have said it better myself.
Now, before we wrap things up, I've got one final thought I want to leave our listeners with. Something to ponder.
I love a good thought-provoking question.
Hit me.
So we've talked a lot about how these potential tax changes might affect where MNEs choose to invest, right?
Right, where they decide to put their money.
Exactly. But what about how much they invest overall? Could it be that instead of just shifting their investments from one place to another, maybe some MNEs might actually scale back their investment plans globally?
That's a really interesting question.
Right. Something to think about.
It really highlights that while this deep dive has been, really insightful, it's really just a starting point. There's still so much research to be done in this area.
So much more to explore.
Exactly. And that's why I always encourage everyone listening to stay curious, keep asking those tough questions, and never stop digging for those fascinating insights.
And on that note, we'll leave you to your own deep dive into the world of corporate taxes and M&E investment. Until next time, happy learning.